क्या आपके साथ भी हुआ है कि यू गो टू अ रेस्टोरेंट फॉर अ बुफे एंड यू आर नॉट एबल टू डिसाइड व्हाट टू ईट एंड व्हाट टू फिनिश द मील फॉर द बेस्ट सेटिस्फैक्शन? मुन्नी के साथ तो बहुत हुआ है. मुन्नी तो कांट इवन ऑर्डर फूड फॉर हर सेल्फ इफ देर आर टू मैनी ऑप्शंस. तो भाई स्टॉक मार्केट में इन्वेस्ट करना तो बहुत दूर की बात है. विच स्टॉक टू पिक, विच स्टॉक टू बाय, विच स्टॉक टू सेल एंड व्हाट टू डू विद इट. मुन्नी बहन तुमसे ना हो पाएगा. अगर आप भी मुन्नी की तरह हो और इस मीम से रिलेट कर पा रहे हो तो आपके लिए भी म्यूचुअल फंड सही है. बट म्यूचुअल फंड इज ऑल्सो सब्जेक्ट टू मार्केट रिस्क, इसलिए रीड द डॉक्यूमेंट्स बिफोर पुटिंग योर मनी इनटू देम. पर ये डॉक्यूमेंट्स हैं क्या? डोंट वरी मुन्नी, मैं बताती हूँ. Let's start with what is a mutual fund. See, there are two stock exchanges in India, NSE and BSE. They have thousands of companies listed under them, right? So there are thousands of companies that you can buy your stakes in. But since you are a beginner, you want someone to manage your stocks for you. So mutual funds do exactly that. There is a manager who has a basket. He picks all the good looking stocks for you and puts them inside the basket. So now you invest money in this basket of stocks, not in one company, but in multiple companies at the same time. Then when the time comes, this manager buys and sells the stocks within this basket so you can get the maximum profit out of your investment. Understood? Now, these mutual funds are of many types. Index funds, equity funds, debt funds and more. We will talk about these in a separate video. Comments में बताओ अगर तुम्हें इसका एक detailed video चाहिए. Now coming back to the topic, how to pick the right mutual fund for yourself. Well, there are some key components that you need to look at before investing your hard-earned money in a mutual fund. Now these are the top performing mutual funds right now. तो इसका मतलब ये नहीं कि you just pick the one that gave you the highest returns last month and be like ये मेरा पैसा तो डबल हो जाएगा. No. So like you pick a stock to invest in, you look at its financials, profits, its returns over years and so many things. You also pick a mutual fund by looking at its performance, risks, costs and more. And to analyze this, there are a few metrics that you should know. First, analyzing the performance of the mutual fund. Now this is CAGR, compounded annual growth rate, kinda like growth in say these many years. What professionals do is that they look at rolling returns, because just 1 year of growth of a mutual fund can be purely out of luck too. So you need to look at returns over the years. How will you do that? Well, take a fund X. See the return over 4 years from 2016 to 20. Say it has grown from 100 rupees to 120 rupees. So the return is 20%. Then it has grown from 120 rupees to 150 rupees from 2017 to 21. So the return is 25%. From 2018 to 22, it has grown from 150 rupees to 180 rupees. The return here is 20%. Then from 2019 to 23, it has grown say 180 rupees to 215 rupees. So the return is 19.4%. Same thing you do with fund Y. From 2016 to 20, it has grown say 30%, then 20%, then 8% and then 5%. Then obviously fund X is better. This is called rolling return. So basically you see how much return the fund has given in like 3 to 4 years continuously, not the average return for 10 years. This is easily available on Google, so you can find the rolling return of the fund by searching on Google itself. Then comes Sharpe ratio. Sharpe ratio gives you an understanding of how much risk you are taking for that return. You can get the Sharpe ratio on any website that you refer to for your investments. So you compare this ratio with the other funds too and then decide which one you need to go for. It is calculated by dividing the difference between the mutual fund return with risk-free return by the standard deviation. Now what standard deviation and risk-free returns are? Risk-free returns are the returns given by government securities. Standard deviation is how much difference is the mean time from the actual time. Say there are two funds. Fund A gives you 100% return, but it also says that due to unforeseen circumstances, you might lose 99% and only be able to gain 1% from this fund. But Fund B gives you a return of 10%, but due to unforeseen circumstances, you may lose 1%. So now, which one will you pick? It is Fund B for sure, because you are getting 9% return on this one. So this 99% in Fund A and 1% in Fund B is the standard deviation. So this also measures the risk that you are taking, the delay or the most loss that you will get if you invest in this fund. Now coming to another thing that analyzes the risk for you is beta. It measures the fund volatility with the benchmark indices. It could be either Nifty, Nifty Bank, Nifty 100 TRI or anything. So say if your beta is 1, which means that your benchmark volatility and fund volatility is same. So now you want your beta to be less than 1 because then your fund volatility is less. Similar to this is the capture ratio. Under this there is an upside capture ratio and a downside capture ratio. Here say Nifty 50 has gone up by 10% and your fund has gone up by only 1%. Then the fund is bad, right? Now if your fund has gone up say by 20%, then your upside capture ratio is 2, which is fund return divided by the benchmark return. Now the downside capture ratio is opposite. Say Nifty falls 10%, then you want your fund to fall more than or less than 10%. Less than 10%. So the downside capture ratio should be less than 1. Now coming to cost analysis. First is total expense ratio or TER, which is the cost of the mutual fund that it is taking to manage your assets. So you should choose something that is in the mid-range or in an acceptable range by comparing other funds too. Next is AUM, which is assets under management, which is the total amount of assets that the fund manages. Now this is something that is the last thing you should see honestly. For these two there is no upside or downside range. You need to see the funds in your category and then decide which one is best for you. There is one more metric that you need to see before choosing a fund according to your risk profile, the portfolio turnover ratio. This is basically the frequency of how many times do the mutual fund buy or sell securities under it. A high turnover fund with ratio of over 100% means that they replace their entire portfolio at least once in a year. It means that they look at short-term stocks, more volatile, more risky, but may generate more returns in a bullish market. Low portfolio turnover ratio means that they trade in long-term stocks, less risky and more stable, but may give lower returns in a bullish market. So these are the things that will help you to pick the right mutual fund for yourself. So go ahead and start investing and make your choice smartly. Don't be like Munni. I will see you in the next video.
If you like this video, then like, share and subscribe to ET Now.